Very pleased to be joined today with Abby Miller Levy, as you mentioned, the co-founder and managing director of Primetime Partners. So this is a top VC fund, very much focused on innovative solutions to solve America's aging problem. And for those who want to learn more about that, I will just put out, we do have a Bloomberg Business Week magazine on the topic, the longevity issue, so please do check that out. But to give you a bit more background, first of all, on Abby from her bio, she's had various roles before launching Primetime Partners, including executive positions at SoulCycle, and been an entrepreneur herself, teaming up with Arianna Huffington to launch Thrive Global, which was a leader in employer well-being solutions. So Abby, let's start off with the beginning of your career. Thank you for joining us today. So you spent time at McKinsey, but also a number of years jumping around in sort of advisory roles at different startups and companies. So how did getting into the weeds with a lot of the executive team at these companies kind of shape your thinking about consumer behavior and how you can build a business to solve a core need and be successful at that?
Well, thank you so much for having me, Cornell and New York Tech Week and Bloomberg and Ritika. Well, first of all, if we're going to get the origin story, let me start by saying I'm a New Yorker. And so I think it's always important to know your crowd. I am also a daughter and a caregiver to 3 children and to 2 parents and 1 mother-in-law. And I think it's really important to always think about our stories in the context of where we started from. So to get to your question, I have often thought of my career as a Goldilocks. This one's too big, this one's too small, this one's too hard. We all know the Goldilocks story, and then this one's just right. And so I'm very happy to say that at age 45, I found the one that was just right 4 years ago in starting Primetime Partners. But how I got there is really this layering of experiences that started with being the daughter of a small business owner. So I grew up in the kind of thinking about products, consumers, growth, how to build things. After college, I studied languages in college, and then I went to McKinsey, which is an amazing, consulting's a great place as a young person to start a career because you get to learn a little bit of everything in New York and in London. Went to business school, where the best class I took at business school was actually a career planning class, where I didn't figure out what I wanted to do. I just learned some skills on how to do that. And then joined OXO, Kitchen Tools and Gadgets. And that was a real, you guys aren't familiar with the good grips, big black handled carrot peelers, salad spinners, trash can line that I started. So OXO was a really wonderful experience in understanding how to design for consumers and to design for quite a broad range of consumers. And it was an apprenticeship. And so I think that we don't use that word often enough as we think about career development, but it really was an apprenticeship in understanding product development and forever oriented me towards delighting consumers. And so I have taken that theme throughout, from my father and his small toy business to OXO to 7 years of freelance consulting with a variety of companies, always on product, market, growth, to then starting a business with Arianna Huffington called Thrive Global, which put me in the healthcare and wellness space. For those of you who aren't familiar, Arianna has written multiple books, but her most notable or most recent ones were The Sleep Revolution and Thrive, and that turned into a business that she asked me to start with her so that we could take that knowledge base and employ it in the employer setting. And so one of the best things about that experience was being a startup founder. And that has very much helped me in my role as an investor, because I have sat there and I have pitched VCs. I have launched products. I have figured out how to get corporate cards for our employees, and what all the paperwork that needs to go with that, signing our first lease, all of those things. And so, but it was also the first time that I failed in my career. It's really hard being a startup founder. And it is something that, for a variety of reasons we can get to later, was not where my strengths were aligned. And I was very lucky to join SoulCycle to launch their at-home bike. So actually, John Foley, CEO of Peloton, was in my business school class. So I'd known all about at-home bikes for a while. And so when I was talking with then CEO of SoulCycle, Melanie Whelan, about wellness, she said, will you come launch our bike? I said, great. But while I was working at SoulCycle, that is when I started thinking about Primetime.
Okay, and we'll get to more on Primetime and also Thrive in a minute, but I actually want to stick on SoulCycle here because, of course, you started that in late 2017, if I'm correct, and I think that was a time where this whole idea of wellness was really starting to emerge, and that was a sector that, you know, obviously now in 2020, since 2020 we're talking about it even more, but back at that time you were thinking about, you mentioned product lines at SoulCycle that were outside the typical fitness studios that we all know there. So talk to us about the kind of the challenges that you faced there and also the opportunities when you were thinking about launching those products with them.
Absolutely. I mean, what an amazing brand. So, I mean, how many people here have taken a SoulCycle class? How many people here have heard of SoulCycle? Okay. So to have a small business, the business when I was there was about 75 million in sales. To have a small business like that with 90 locations across the US, where it was just in the zeitgeist, in folklore. The Harvard Divinity School did a case study on it about culture and cults. So it was, yes, exactly. And so it was an amazing experience to really understand, and like when I was at OXO, to understand the power of brand, but another layer here, back to the layering of your career, is really around the role that community plays. And so I think the challenges of working on new business extensions for SoulCycle at the time was, would this translate to digital? Would this translate when you weren't physically face-to-face with other community members and with the talent, who are the instructors? And the answer, as we've seen, is absolutely. Especially, no one could have anticipated COVID, but COVID was basically an unlock for digital fitness, because right now about 50% of the visits that used to go to the gym are now in the digital arena. So I think that was a real learning, is that that digital works in general, and especially if you have a brand and talent. I think the things that are hard are things like basic unit economics. So when you have a high price point product like $40 per 45 minutes or up to $60 at SoulCycle, that it's hard to sometimes decide to do anything else than the cash cow that you have. At OXO, what that was, and so again, the carrot peeler, $5.99 product costs about 35 cents to make, right? We could sell as many carrot peelers as we wanted to, but a $25 salad spinner is always going to be your top selling SKU because of the price point. And so it's a really important lesson in basic economics, which was really hard for SoulCycle, and still is for fitness, to move away from anything that wasn't the high price, high margin product.
And then moving on to Thrive, where you become a founder. So talk to me about actually how this even came into being. I mean, did Arianna happen to just call you one day and say, look, I have this great idea for wellness in the workplace and employer productivity? How did that all come together?
Well, I apologize, I cannot imitate her Greek accent because it would sound much more authentic if I was able to. But I had known Arianna socially, and through a friend had seen that she had, who had talked with her, with a very thin PowerPoint deck in probably New York Times Roman 12 on the front, black and white, Thrive. And my friend, as I just met with Arianna, she's thinking of launching this business. And in my Goldilocks moment, I said, well, I'm sure I could help her. So I emailed her. I said, I had been doing some prior consulting work to a company called MindBody, which is in the fitness booking space and in the wellness space. So I emailed her. I said, I have some ideas for your business. And I remember I went down to, she was then still editor-in-chief of Huffington Post. I walked into the Huffington Post office. And again, I wish I could imitate her accent. She, kisses both cheeks, and she goes, I love that shirt. And then I was sold. Like, you know, she loved my J. Crew button down, and I was sold. But the way that it came together was really in that 45-minute conversation, where I was using my McKinsey skill set and all these other things I'd done to give her a long list of here's what I'd do if I were you. She literally turned to me and said, "Great, do you want to run it?" I said, "That sounds great." And so a month later, I was the president, and you know, that's how that got started.
And you know, obviously since COVID, there's been so much more interest in this space, as we were discussing, and more focus on employee wellness and productivity. But did you see that same kind of interest when you started it in 2016?
I mean, Ariana, this is her life's work, her brainchild, her genius. And the answer is absolutely. I mean, she had major Fortune 100 CEOs from the very beginning understanding that wellness in the workplace was a liability as well as an asset. And so employers who could differentiate on wellness in the workplace would win the war on talent. That conversation had already been happening. I mean, that's where fitness had kind of made its inroads into the workplace in the 90s. And so there was that conversation on being an asset, but there wasn't this conversation around stress being a liability. No one had been talking about stress in the workplace. And I think a lot of what we'll be talking about when we're talking about Primetime is how do we take topics that people don't want to talk about and then mobilize them to fix them. And I think that's where Ariana has been so outspoken and such a genius in being able to say, we have real issues with the wellness of our population around stress and mental health and connectivity, and how do we fix that? So it was very strong, and then only got, I think, exacerbated and augmented through COVID.
So it sounds like it was, you know,
the business is doing great.
It sounds like it wasn't too hard then to get fundraising at the time. A lot of people are interested.
I mean, I think it's always hard to, when you have just a pitch deck, to get funding. But given the team, we did raise $7 million in a couple weeks, month, to launch the business.
And then I wanted to jump here to your jump, in fact, to the VC side and actually being on the investor, and what kind of key insights that you were able to transfer from being the founder of Thrive and then bringing that over to the investor side, and also what perhaps were some things that caught you off guard with that jump too?
It's an interesting question because I think of Primetime less as an investment firm, but more as a startup. And the reason that's both because it is a startup. I mean, we started it from a piece of paper. That same PowerPoint deck in the Times New Roman 12 font was also how I started Primetime. So that was a startup, but also that the idea for Primetime came from me trying to solve my own problem of my parents. I'm very lucky. My parents are healthy. The majority of entrepreneurs we meet come to us because they've had some I'd say negative experiences with the healthcare system or concerns about financial longevity, and so they have their own pain point they're trying to solve. My pain point was my dad's business went bankrupt 20 years ago. He's not a 1%er, doesn't play golf, and it begged the question of what does he do? What does he do in his 60s, 70s, 80s? And when you start to look at what exists in our society for people to meaningful contributions for older adults, it's slim pickings. And so I started writing business plans of what business to start to help solve this. And somebody, I don't know who, said to me, why don't you just start a venture fund to invest in dozens of these businesses? And so that's how I ended up becoming an investor, was not because I had this burning desire my whole career that, yes, one day I want to grow up and be an investor. Mm-hmm. It was that this is the right business to solve the problem that we want to solve. So then to get to your question, a roundabout way, I think what I learned from being a founder is that has helped me identify founders to invest in is to a couple things. One, friction exists when you're starting something. There's friction in building a product, friction in hiring a team, friction in channel. Can you find businesses where somehow the founder has managed to reduce that friction, where there's less friction? In the case of Thrive, it was Ariana and sales. Reduced friction. You know, she's at Davos, she's talking with the CEO of GE. I mean, like, no friction in the chat, in sales. That is very helpful. Alternatively, on product, we're talking now about, you know, the biggest, you know, all these fundings with AI. they reduce the friction by having a proprietary product that you need, like that's necessary for other businesses. So I think one thing I realized was where you can reduce friction in any of those areas, you have an advantage. And so that's just kind of one thing I learned in terms of becoming a better investor. The other piece of things that I learned, which is the majority of business is about relationships and your ability to, whether it's attracting talent, funding, sales, it's all about relationships. And I think that's something that oftentimes gets a dirty word, like, oh, networking, as if, and by the way, you're all here tonight, right? And that those relationships aren't transactional. It's how you learn and how you truly exchange, just truly helping each other. And I think one of the nice things about being in a startup, and for all those that you are in the startup, is it is the most generous community. I mean, it really is. Like, we all help each other. And so you're going to have to put yourself out there and ask for help. And I think that's one of the things that was great about being a founder, is that, especially I had to say as a female founder, there was, and whatever affinity group you belong to, lean into your affinity group because you will help each other. And so I think that's also helped me as an investor, but also identify founders. One of the first things I do is see how many connections do they have on their LinkedIn profile. If it's not a lot of connections, that's concerning to me.
And moving on to, actually going back, I should say, a step to talk a little bit about the origin of Primetime Partners. So you mentioned what motivated you, and you co-founded this firm with Alan Patricof, of course, a legendary VC here in New York City. So you've talked to us a bit about your passion for it. How did it sort of come to be?
So it was summer of 2019, and that's where I said, you know what? The right business to start is this venture fund focused on aging and longevity. And so I was working on it, and I had a couple of corporates that were going to work with me, but it was at a Halloween party you want the whole story. It was at a Halloween party where I bumped into my friend John Patricof, who is one of Alan's 3 sons. So by way of background, Alan Patricof, he's the spokesperson for Primetime, as well as the chairman and my partner, because he, at age 88, just got married 4 weeks ago. He goes to Burning Man, runs the marathon. He is the most, his vitality and commitment to entrepreneurs and the venture capital community is outsized. He just won the award for the National Venture Capital Association. He's amazing. And so when I was talking to my friend Jonathan, and I mentioned I was going to start a venture fund focused on aging and technology, he said, oh my gosh, that's what my dad wants to do. Now, I was very fortunate because I already knew Alan, because he was an investor in Thrive Global. He had backed Ariana at the Huffington Post. He was on my cap table. We were on the board together. So it wasn't a chance encounter. But as most things happen in New York, his son Jonathan arranged a lunch at a diner on the West Side and we can't figure out why it was the West Side because we all live on the East Side. But we went to right in Times Square, and we had our corned beef sandwiches and hashed out the plan for Primetime, and that was November of 2019. And in March of 2020, we were on the phone saying, okay, we have a name, we have a website, we have a deck, let's start fundraising. But something else happened in March of 2020, which is we all went into hibernation. And Alan, in his infinite wisdom, said, this is the time to go. Let's press go. So on Zoom, we raised $50 million over about 4 months of fundraising. And it was actually wonderful as a working mom. I didn't have to leave my house, and I got to do all of that. And that's how it started.
And talk to us about the focus on longevity tech. I actually read the stat that I think recent stats show that the percentage of the US population that's over the age of 65 is about 17%, but it's estimated, I think, to grow to 25% by 2050. So as a VC, you've got a long time horizon when you're looking at investing. So clearly present some sort of opportunity here. So why is it important, and how are you preparing for it? And actually describe what in fact it is, longevity tech.
I've had such trouble figuring out what the name of this is. Is it longevity tech? AARP calls it age tech. There's a lot of different terms for it. But I think at the heart of it, if I think about the investment opportunity, there is life sciences, biotech, FDA, medical devices, that's trying to help us extend our health span. they're working on, and there are huge, huge funds doing this. They are working on how can everyone get to live to be 100. And what my side of the house is, it says, what if they achieve that? What do we need as a society to sustain an older population? So what is the infrastructure and services layer that is needed across healthcare, financial services, housing, consumer, media, workplace? How do we handle this aging population? And so I'm having trouble coming up with a name for that. And so I just kind of talk about the longevity economy as just all of the infrastructure we need to support an aging population. So that is how I think about the landscape on a global scale, because the big shift that I think it's hard to recognize is it was only 60 years ago where 1 out of every 10 people in America was over the age of 65. Now we're at 1 in 5. So we really, while the actual lifespan, people talk about, well, the age span hasn't changed that much, especially COVID, it went down a little bit. And so we're still hovering in the mid-70s. But according to many different scientific, including the World Health Organization, those individuals born after the year 2004 have a 50% chance of living to 100. So my kids have a 50% chance of living to 100. Our society kind of stops at 65. You're not working. I mean, the average retirement age is going down, not up. We have our housing stock hasn't been renovated in 21 years. I mean, there's a lot of things that need to happen for a centenarian population. So that is kind of the underlying investment thesis. And when we started, there were 2 other funds focused on this topic. And there have been 5 funds that have launched since. This is, and I think I mentioned this to you on our prep call, I very much view this where climate tech was 15 years ago. The data was irrefutable. We all knew it was coming. We had our head in the sand. And then we relied on government to try to fix it. So then we had a bunch of private sector working with government. And the same thing's going on with aging.
And I want to dig into your portfolio here, because you did mention a range of sectors.
Yes.
There. So and you're early stage investors. So I imagine predominantly healthcare would be a very big part of that. But talk to us a bit more about your portfolio and what kind of areas you're in.
Great. So invest seed to Series A, B for Fund 1. And I'll tell you a bit, we're refining our strategy for Fund 2, which we're launching now. And I was really surprised with, I don't know why I was surprised, but healthcare is 2/3 of our investing. And I had never done traditional healthcare investing or hardcore healthcare till 4 years ago. And that is because older adults consume 2/3 the healthcare in our country. And so as we started looking at all the inbound, we look at about 600 companies a year, and the majority were healthcare. And so basically outside of pediatrics, maternity, and oncology, every healthcare issue is an older adult issue, because that is just how our biology works as we age. And so the healthcare piece in terms of the types of things we're investing in are everything from I'd say the social determinants of health, so fitness, nutrition, mental health, social connectivity, all of those pieces of aging well, as well as some pretty direct healthcare IT around telemedicine and cardiac rehab and remote patient monitoring. And so there's a lot of, I'd say, harder and softer. But the one common theme in addition to serving older adults, amongst all of our healthcare investments is the pace of regulatory change is very fast in this space. Perfect example is telemedicine. I'm not sure if you guys know this, but before COVID, telemedicine, with only an exception, was a reimbursable expense. That it was not viewed as something your health plan would reimburse. Now how many of you have used telemedicine for doctor's visits? Yeah, it's 77% of the US population. So that's an example of where there's so much opportunity for healthcare investing because there is a tremendous amount of innovation on the life sciences side that's then fueling regulatory change, which is fueling opportunities for entrepreneurs. Perfect example, we just made an investment in a business called Isaac Health, which is in the Alzheimer's and dementia space. They do dementia care management, diagnosis through to family and individual care management. CMS just passed a ruling which is the Center for Medicaid and Medicare Services, basically the government funding entity for all of healthcare. And since healthcare is a third of our economy, you kind of listen to them. And so they are now reimbursing care management for dementia families afflicted with dementia.
And you picking up on a word that you used here, changes constantly in the space. So I would be remiss if I didn't ask you about AI and how your kind of Primetime is riding that wave. Are there any particular companies that are pitching to you or that you're also investing in that are using AI? And I think healthcare, in particular, it's traditionally very service-based. So what kind of tools are they using?
Yeah. I mean, if anyone has texted to make an appointment, AI has been there in healthcare. I think people keep talking about, it's all new. It's been an evolutionary process of language models over time that have been deployed largely in customer service use cases. So a lot of our companies are using it because healthcare to your point, is a service business. How can we take pressure off of our service professionals by having, as one of my CEOs said, having robots do the job that robots do well and people do the jobs that people do well. So I think that as a base case is, as table stakes for a lot of startups and how they use AI. I think where things then get more interesting and the next layer is on data crunching and personalization. And so the opportunity in healthcare is personalized healthcare. Whether that's from clinical trials and genome sequencing and all of these things and polypharmacy, which is a fancy way of saying the average older adult with chronic conditions takes 10 to 12 medications a day. Like there is a lot you can do with AI on just data crunching and personalization. So I think those are the two areas, customer service and I'd say service delivery, and then on personalization. We have a joke on our team, not a joke, but do you get a valuation bump when you put AI on the cover of your pitch deck? The answer is obviously no, but it is very much like those college drinking games where when someone says the word, do you do a...
Well, we mentioned a lot, you talked a lot about the investments in healthcare, reducing the cost, increasing the accessibility, but I imagine that financial planning is also key. So I'm really interested into what kind of investments that you're looking into there and why they're so important.
So if I had to say that I had a favorite area of what we do, it's a smaller area. FinTech and solutions related to that have been about a fifth of our investing. I am very worried about the fact that 50% of Americans are going to run out of money. We don't talk about it. I think we intuitively know that it's a lot, but we say, well, that's what the safety net's for, that's what government's for, but it's not that they start out in poverty. It's that they're going to age into poverty. And that is really concerning. And it's something that I think we have been relying on government to solve for us. So I get really excited when I think about the businesses and startups we're looking at that are trying to figure out how to change the math so this doesn't happen. The number one thing is work longer. I know that it's an unpopular idea, but that's really in some ways the responsibility of where employers need to move to. We have an ageist society and ageist, HR and not HR. Most employers don't think about ageism as one of their DEI isms. And so how do we think about people working longer, but also how do you as a young person think about these chapters in your career so that you're finding roles in your 30s and 40s that you're comfortable doing into your 60s and 70s? Because we cannot have a 50-year retirement. You cannot retire at 50 unless you're super affluent and live to 100. So that's an example of financial, in this bucket of affording the 100-year life. Retirement savings products. I get asked all the time when I tell people what I do, Abby, what is the secret to longevity? And I always say maxing out your 401k. And people are so disappointed that I don't have a pill or a website or a program for them to go to. But it is the decisions, my point is the decisions we make in our 20s and 30s compound and are the best decisions we make for our healthy longevity. And financial longevity is such an important piece of healthy longevity, because if you don't have money to feed yourself or pay for the dentist, you're going to have healthcare problems. And so thinking about retirement savings and different products and services, there's an entrepreneur in the room today who was just talking to me about that, really excited about retirement savings. And then the last piece, and this is kind of my Debbie Downer point, which I apologize about, which is majority of Americans think that home care is reimbursed or paid for by your health plan. What I mean by home care is the lovely professionals that can come into your house and help you with your activities of daily living. On average, it's going to cost an American $50,000 in their lifetime of in-home care. It is not paid for. There's a product called long-term care, only 7% of Americans have. We all should have a version of long-term care. There's long-term care 2.0. We've invested in a business called Home Care Genie that does it, but really getting excited about people thinking more long-term about the cost of care.
And you launched Primetime in 2020, as you mentioned, which, of course, COVID swept over the world, put markets into complete disarray. So did that shift the way, or did it accelerate in any way you getting the funds?
That's a good question. Yes is the answer. For when we went out and pitched, I'm a first-time fund manager. So it's like a first-time founder. It's a lot harder. I had a wonderful ace in the hole with my partner, Alan, who has been doing this for 50 years. So he definitely had folks that we could go talk to. And most of the folks that we talked to were high net worth individuals, ages 60 to 80. So think about it. It's COVID. They're quarantining. They're worried about their health. And here comes a pitch deck for a venture fund focused on aging. So the timing was right, and I don't want to take, someone said, don't let a good pandemic go to waste. I'm like, that's an awful comment. But it was definitely top of mind. So I think what was most top of mind, though, was that everyone became a caregiver. And so if you weren't thinking about aging, if you weren't aging yourself, you were thinking about aging, because it was the first time in media history where nursing homes were on the cover of every newspaper, every magazine, every cable news channel. There were the first 6 months of COVID where we were helping our aunts, our grandparents get access to vaccines, figure out how to order from Instacart. We were all caregivers, and it became very personal. And so when now we go talk not only to funders, but to other VCs about what we do to collaborate with them, and we work with about 200 other VCs, that always the conversation veers towards the other person across the table telling me a story about a loved one that they have had an experience with, and why building infrastructure and services for aging is so critical. So I think it changed the consciousness that then allowed us to move much more quickly. And then the last thing is Zoom. If I had to get on a plane and go talk, we have 90 investors in our Fund 1. If I had to go talk to the 300 people to get the 90 investors, it just would have taken a lot longer.
And very quickly, just because we want to spend some time on your outlook for 2024, of course, but I thought this was really interesting that Primetime, of course, you're focused on founders building for older people, but you've also focused on older adult founders too. And I think there's this stereotype of the young 20s, the workaholic founder. How are you kind of breaking that?
It is absolutely on our wish list. And what I mean by that is that Fast Company, as well as HBS, have both done studies to show that the most successful entrepreneurs are in their 40s and early 50s. And it's very obvious why, which is experience, pattern recognition, network, wisdom, ability to hire, all of those things. So we know that it's actually the most fertile, or probably the founders that we would love to recruit the most are going to have more experience and potentially be older adults. In our current portfolio, only 10% are, 10% of the 36. So we would love to find more older adult founders, but as I myself am 49, I started business 45, it's not a very attractive role or career choice for people in their 50s because of that issue of the work-life balance, as well as just the network. A lot of people who have had executives who have had long careers in their space don't know this whole world. And those of you who are in it know it's a world, it's its own ecosystem. So it's hard to break into that. So we definitely, on our weekly investment pipeline, we star founders who are 50 plus. We want to give extra time, extra work to encourage them to succeed.
And speaking of that, I'm just curious, how many pitches would you say that you probably reviewed, if you can put a rough number on it, since you launched the fund?
So we have looked at about 2,000 startups. The majority of them are inbound, and they come inbound from, first of all, about 65% from other venture capital firms. And one of the great things about being a thematic venture fund is because we cross the different sectors, we work so nicely with healthcare, fintech, prop tech, consumer tech, AI, whatever it is, we're the subject matter experts. And in fact, there's a study done on companies, from PitchBook did a study, that thematic funds outperform other types of funds by 46% IRR between 2010 and 2020. Because being able to have that expertise is really important. And so that is where we get most of our deal flow, are from other funds saying, hey, Primetime, what do you think of this?
And is that actually something that you would advise founders to go to kind of more specialist VC funds?
Absolutely. And I would absolutely understand their LP base, because so much of our insights come from who's in our network. And I always tell founders, interview other CEOs to understand when a VC says they're going to be value add, and I put it in air quotes because VCs do put it in air quotes. I don't know why, it's a real thing, it shouldn't be in air quotes. But when someone says we really work and help our portfolio, push them on it and go talk to some CEOs who have benefited from it.
And moving on to looking at the year ahead, I mean, of course, it's been a tough environment for fundraising, but what has been your deal flow to date, and do you have any targets in mind for this year?
So our deal flow was down about 25% in 23. And for those of you that don't read the venture rags that have been screaming about these topics all for the past 2 years, venture investing was down 30% in the U.S. In terms of overall versus 2022, but we're still higher than we were in 2018. So I think we have to put it in a bit of context. But it did affect us in 23, and most of our portfolio, we did have 3 companies go under in 2023, which as a mother is just like, brutal, like when, you don't expect any of your babies to go anywhere, but all for good reasons. And we also had most of our companies that said, we are not going to fundraise. We are going to try to get to profitability. We're going to stretch our dollar further, or we're going to, do a lot of things to stay out of market for as long as possible. So what that means is wonderful things for 24, because you have companies that have been waiting on the sidelines to raise, who are going to come to market. There are a lot of, I'd say, insider rounds happening. So one of the reasons why there's a lot of insider rounds happening is that in 2023, 20% of deals done were at down rounds versus 8% the year prior. So a lot of companies do not want to do down rounds, which then leads to the insider round, which is typically a flat round. And what we have found is that we already are looking at one deal right now where, because we are viewed as a strategic LP or a strategic investor because of our thematic focus, we are being invited into insider rounds. And that is a wonderful place to be, because you get access to deals at good prices that have been very well vetted. So what am I seeing for 2024 pipeline? I am seeing Bs and Cs coming to market at good valuations. I am seeing deals moving very fast, being led by insiders. They do not want to distract founders with 9-month-long fundraise processes. And since they have powder, because they haven't spent it in 2023, they can spend it in 2024. We're seeing PE firms. I mean, the venture conferences I go to where there's big PE funds fishing in the venture world is an opportunity to flip it around. So I've started to go pitch PE funds on, hey, let's combine this in this company, or let's do this. So we're also seeing, I think, folks that are not traditionally venture investors being interested in that space, because everybody thinks that there's going to be deals.
And are you concerned about kind of the interest rate environment? I mean, we just had, of course, a year we've had capital out the door, we've had valuations being sky high, and a big part of that tied into what we're seeing in the macroeconomic picture. So is that like a key concern for you?
And that's the hard thing of having, it's like two sides of the same coin, right? Because it hurts the existing portfolio, but it helps the new investments you're making. So there is that piece. And also, we're early stage, so we are not sensitive to the IPO market because our companies are still, 3 to 10 years away from that. So I think the early stage venture funds have been pretty insulated from that environment, with the exception, of course, that we do fintech. And so 2 of the 3 companies that went under in 23 for us were sensitive to interest rates, and they're fintech companies, and that has made fintech quite a hard place to be.
And do you adapt your kind of evaluation models, from when there was that big frenzy in the fundraising of late 2021, 2022?
Yeah.
Is that different today?
Well, I think 2 things are different. One is that I'm sure you've read a lot of venture funds mark down their portfolio. In fact, General Catalyst, which is a very large venture fund, they went through, and I really respect them for this, and they rewrote their exit memos. So if they made the investment, you typically will have an exit memo that says, based on what we know today, we think the valuation could be this, et cetera, and therefore we're investing at this price. They rewrote all of them, and they marked down their portfolio tremendously. So I think what that has done is it has, for all of us, seen whether or not we needed to mark down. We have only marked down one of our companies. Everything else is, we're comfortable with that valuation. In terms of revising valuations going forward, I always like to say we're East Coast investors, not Silicon Valley investors, so we've always been pretty conservative on valuations. In addition, my partner, Alan Patrikoff, is, I'm not going to use the term old school because that's an ageist term, but he is prudent. And so we do not need to change our valuation models for 24.
So nonetheless, you see 2024 as a much brighter outlook, but we've
Absolutely.
had a challenging 2023. But what advice now would you give to kind of early stage investors or founders hoping to kind of raise their first round of funding in this environment?
Well, we didn't talk about that. It is an awful time to be raising a fund. And the reason for that is that investors have not had liquidity. So in other words, if you are an institution or a family office that says, I'm going to allocate 20%, which is typical, 20% of my equity investment to venture, if you haven't gotten money back from your venture funds, which you haven't from 2021, 22, 23, then you cannot deploy more capital into venture. So that is still quite tight. So for those that are looking to raise capital for a venture fund, so I'm saying if you want to raise capital for a startup, markets are open again, go for it. As a venture fund, I think you need to expect a longer timeline, reduce your expectations of how much you're going to raise, and not put it as we're going to raise and then invest. It's going to be a rolling process. So manage your timeline where you're going to be just more iterative on the fundraise process versus the sequential nature of it.
And speaking to an audience that we potentially have a lot of soon-to-be entrepreneurs, so what advice would you give to them when it comes to pitch decks and making a successful pitch deck? And what do you too often find that can be missing?
Do your best to get in the room or on the Zoom. Decks are just such a small piece of the process. And so I think less is more. If someone says, can you send me a deck? I would say, here's a 1-pager. I'd love to set up a meeting with you. Because I think that you can send the deck afterwards, but you're at this point in early stage, someone's betting on you, not your deck. And so the earlier you can let them understand how amazing you are, how compelling you are, why you, I would recommend that. So I think a 1-pager or a 2-pager is, Word document, looks pretty, totally sufficient to get in the room or Zoom. Within that, I think people wait too long in their deck to get to money. That's always the last page. Oh, and here's how we make money. If you flip it around, you'll get the attention much faster. I always liken to, like, for me, like, I always wait so long when I was looking at businesses to get into Excel. Get out of PowerPoint, open Excel. Like, that's ultimately what your job is to make money. And so the sooner that you can understand what about your business will allow you to make money, and what are the concerns of why you're not going to make money. So I think that's one thing on pitch decks. And I think then the other piece on pitch decks is, if you can have proof of concept. That can be anything from a survey you send out, to a dummy website, to interviews. Whatever the proof of concept is, that's your evidence. Bring it, do something where you can really prove the concept beyond just the idea.
And moving forward, before we get to the Q&A, what are your kind of outlook for sectors? Where are you most excited about? Maybe perhaps outside of the traditional wellness space.
We just, because of Fund 2, we just put together our 6 investment themes. And I would say that because most of what we do is enterprise sales, there's not a very well-developed consumer market of older adults yet. We're working on it. So enterprise channels, the healthcare systems, payers, providers, home care, all of that, senior living. Same on retirement. We're talking about wealth managers and employers, et cetera. And I think right now what you see is, if you look at just how many startups have come to market in the past 5 years, enterprise channels are overwhelmed with small businesses knocking on their doors. And so where we see the brightest light is, as I mentioned before, less friction and urgency around results this year. What can you do to improve someone's revenues or reduce their costs to improve their bottom line in 2024? Companies that do that are of interest to us. In my space, that means reducing hospitalizations. It's the fastest way to help people save costs in the health system, because the average hospitalization is $20,000 to $30,000 a pop. And the way you do that is to make sure someone doesn't, or a loved one or someone doesn't pick up the phone and call 911 when they don't need to, or they don't feel like they can't access healthcare unless they go to the emergency room. So that is a big investment theme. One of our 6 investment themes is literally reducing hospitalizations. And there's a bunch of different tactics to that. But I guess, so to answer your question, where do I see, I look at it more from a business model perspective of where there is immediate revenue or savings to your channel in 24.
And any sector you want to avoid, you just don't want to touch?
I think retail is going to continue to be really hard. And I think consumer, there's just a lot of not even just inventory of companies and inventory of inventory. So I think for us in our world, we're being very careful on those areas.
Well, Abby, I had so many more questions for you, but it is time for the Q&A. So I'm sure the audience has saved up a lot of questions. So I think we've got a mic that we're going to pass around. So if anybody has one, we have that gentleman over there.
Thank you. Hi, Abby and Ritika. Thanks so much for your time. Abby used the word prudent. I was going to go with the word traditional or more old school, but we raised a few million in capital for our startup, but mostly through our consumer base, our customer base, using equity crowdfunding. What is your take with a partner like Alan on equity crowdfunding, which is very newer way of raising capital from accredited and non-accredited investors? What's your thought, and have you invested in any companies that have done that? Thank you.
So in the hierarchy of funding sources, the non-dilutive government or research funding is obviously the best because it's non-dilutive. Founders own money. Yes, great. And I'd say the crowdfunding piece, to the extent that it builds a revenue source for yourself ultimately, is great. But if it's in lieu of validation from an institution, because you cannot get institutional funding, then I think it's you need to not need to. It would be great to get some sort of institutional validation at some point. Venture capitalists, there is a herd mentality, and understandably, people are trying to find anything to de-risk a deal. And so having someone else having done the diligence and understand and bet on you is one of the indicators of de-risking a deal. The crowdfunding does not achieve that. But if it achieves a revenue goal, that's wonderful. I think the other piece, though, if Alan was here, he would say all cash is green. So it's not a penalty by any stretch. I just would say continue to make sure you've got other validators, even if it's not funding, of that this is going to be an amazing big business.
I know that you said that you were mostly doing healthcare stuff, but when you think about that, most of this, since the boom of OpenAI hitting the market, and now, venture seemed to have slowed down, except now for anything with AI is if it's a bet, it's all on. You didn't really talk about that in the healthcare space, and you said a thing about AI's always been there, but IBM's Watson has been trying to, because of the regulations with pharma and HIPAA and everything, I feel isn't it sort of harder for big tech to, crack the healthcare thing with AI? So I just what your thought of the craze of AI now, and I'm in marketing, and I feel people are worried about if Google and the chatbots, if Google releases its thing to the public, it's just in beta, it might totally change all marketing for all startups and just everything.
Yeah.
I don't know, just wondering what your thoughts on that stuff is.
I mean, that's kind of the pro and the con of healthcare, right? Which is it's an arcane industry. I mean, it's very old school. I mean, you go to the doctor, someone comes in with a clipboard and paper and writes a bunch of stuff down, and then someone comes in half an hour later and writes the same stuff down, and then someone comes in 2 hours later. So I think people aren't worried about AI in healthcare in terms of disrupting it, because there are so many regulations and other things preventing it from fundamentally disrupting healthcare because of how institutionalized the human services piece of the industry is. So I am not, for the bulk of what we do, it is not of concern. I think, and there will be, there's going to be a regulatory moat around healthcare data for I don't want to project, but it's still there. I think the piece then, which I have to say is, does that ultimately lower our returns as a fund because we're not as exposed to AI? I hope not, and I don't think so, because healthcare is a third of our economy. I mean, it is infrastructure that has to be there to address an aging population. I think there's areas, as I mentioned, where our companies will grow so much faster and their margins will improve much better. They'll get to profitability faster, and they will be able to retain customers longer, and all of the economics of the business are going to improve because of AI. So we don't see it as a detractor at all, or as allowing other people to hurt our startups. We just view it as actually an enabler.
Thank you for being here tonight. It was very interesting for me to hear your background, because I also come from a background in small family manufacturing of consumer goods. And so much of your career was in consumer goods. And then at the very end of your talk, you said, not consumer goods. That's not the direction you're going. But you also said you learned a lot about design. And I'm wondering how your background in your family, in business, have informed the choices you make and the priorities that you put in your decisions today in enterprise business and tech.
In interviews, I often ask people, what's your superpower? What are you good at? And I think one of the things I always say to people in your career, lean into what you're good at. And I think one of the things I've discovered is at the end of the day, I am in sales. That is what a venture fund is. We sell to our investors, we sell to the founders, we sell to partners of our companies to work with them. So what did I learn in these different experiences is that everyone, like consumers make decisions, and you want to influence those decisions. That is what I have done in my career. And so understanding and being able to put yourself in their shoes is, I would say, probably my superpower. Maybe it's because I'm the youngest in my family. I'm very used to understanding everyone else's shoes before my own. But being able to put yourself in someone else's shoes is really what marketing is. And at least in my, generalist experience. So I think that's where there's been consistency around leaning into something that I'm naturally gravitate towards. And then within that, when you ask me about why not consumer, it's that you also have to, as I said, put the Excel first. Like, let's look at the numbers in these business models. And one of the most amazing things about healthcare is that the numbers are so big. I mean, it's a third of our economy. I mean, that's unbelievable. If the average spend in healthcare for an older adult is $90,000 a year is what the kind of the cost of a life is, if you will, meaning like how much a healthcare company spends per person. Like, you have to go with the big numbers. And one of the challenges with consumer products in general is that these startups, the numbers don't get big very easily. Yes, sorry.
I'm Yue Liu. I run a robotics startup.
Great.
With the potential of helping seniors. You mentioned that your second fund is making some adjustment in terms of the investment. I don't know if it's stage or theme. Can you speak a little more to that?
It is stage, so more A's, B's, and C's. But that's partially what I mentioned, is that I think there's a lot of opportunity right now from a valuation standpoint. And it's also concentration. We've invested $45 million into 36 companies. Fund 2, we hope to raise 75-ish and be in 20 to 24 companies. And so one of the great things, like anything, is once you do it for a while, you start to have, you figure out what works and doesn't work, and so we have a lot more conviction in what we're doing. So I think, not that we won't do some seed investing, but I think the market is really primed for taking advantage of what we've learned over the past few years. We've also been keeping in touch. The people who pitched us at seed, where they are now at A, talk about de-risking. I've been talking to these founders for 3 years. My team's been talking to them for 3 years. You really learn a lot about somebody. So it's going to be slightly later and more concentrated. But same, we're going to knock the cover off the ball on aging.
We are just running out of time now, so we do have to wrap up. But thank you all for the questions, and thank you so much, Abby. I think that was so insightful, and I thought we all learned so much from that.